Are you looking to make weekly or monthly income? In this video, I'm going to talk about doing covered calls on stocks to make weekly and monthly income. Throughout my experience, I think covered calls are literally the best strategy to use. So check it out, Kraft Heinz, I have an average price of $39.42, okay? So I ended up buying 200 shares of this position, and then you'll actually see that I've done something really interesting. I've actually sold 2 different covered calls. Now, there's a really big difference here and we need to talk about it. Okay, so the first covered call that I sold is very short-term in nature. It's expiring in just 5 days, okay? So this option right here is a weekly option. I ended up selling a 39.5 covered call. So as you can see, my average price is $39.42. I ended up selling an at-the-money covered call for $39.50. Now, why did I do this? Why did I not give myself more room for upside? And the reason is because Kraft Heinz is not really moving that much, okay? There's a difference between NEO stock, which has more volatility, and then Kraft Heinz, which is a very stable stock. Warren Buffett owns it. So this company is not moving a lot. And for that reason, I want to do closer to the money covered calls. And in fact, if I look at this, the delta, it has changed slightly because I've had this position open after I opened up in Discord a couple days ago. But this position right here has a very high delta, 0.37. In fact, it was a lot higher before Kraft Heinz started falling down because it has gone down by about 2% in the past few days. But I decided to sell an at-the-money covered call because I wanted to collect the most amount of premium. So the premium is the highest the closer to the money you go. So as you can imagine, if I were to pick an option that's very far away, it's not going to have much premium. But I don't mind going very close for Kraft Heinz because I don't expect it to have that much movement. So I can basically bank on 2 things. Number 1, the dividend, and then number 2, the call option premium that I'm collecting. Now, the next thing that I did, because this is low management and pretty good return, is I ended up selling a July 21st covered call. Now, this is a few months out, but what I decided to do was go out a little bit higher to $40 per share. This is still not that much higher. It will give me about 1 or 2% upside in capital appreciation from the stock itself. But what I'm really banking on is, again, the dividend, and I collected $1.10 in premium. Now, $1.10 in premium is actually a lot because this is $110 in premium that I've collected on just a $3,900 position. So this is about a 3% return, plus I'm collecting dividends, plus this is very low volatility. So this is a fantastic retirement strategy. If you have a little bit more money, you can absolutely do safe companies where you sell covered calls. Now, it doesn't matter if you have a small account either, because with a small account, this still makes sense because I'm all about consistency, growing your portfolio slow and steady, getting rich slowly. I'm not a fan of doing anything risky or buying strategies because those strategies are not consistent. They end up losing money, you end up being stressed, and that is not the point of how you want to grow your wealth using options. My psychology is I'm always after safe, passive income, and the covered call strategy is one of my favorite strategies because it's safe, it's passive, it's consistent. And then I can also do the double dividend strategy, which is basically picking low volatility companies and then using covered calls to generate income on them. Now, I do want to talk about different scenarios and give you some tips because if you can watch out for the factors that are affecting the stock, then you can actually avoid a lot of losses. So for example, let me go to something like Oatly. Okay, we can use a number of different examples, but when a stock has really strong momentum and it's going to the downside, what you actually may want to do is you may not want to hold your covered call until expiration. Typically, I do hold my covered call until expiration because I get the biggest raw return, okay? So I typically open a position and I don't even touch it. I just let it expire. And you can actually see that I'm doing the covered call strategy on Oatly. It's going very well. In fact, I'm up $1,000 on a very small position. But I will tell you, when a stock is going in the opposite direction of where you want it to go, and it just continues to go down and it hits a certain threshold. So for me, that could be 5% or 10%. It just really depends on the technical analysis. So let's just take a look at NEO again, for example. It has a really strong support at 825. But for example, let's say that this goes down a lot and it breaks support and it ends up falling. To be honest, I don't even know where it would fall because it's already such a value stock. But let's just say that it goes down to $7. Well, in that scenario, what you're going to want to do is actually roll your strike lower. I won't actually hold the position until expiration in that scenario. So as you can see now, I have a lot of different option positions in my portfolio. I have American Airlines, which I'm doing a covered call. This has been my bread and butter for a very long time. Basically every single 1 to 2 weeks in my Discord, I'm opening up a position on American Airlines. I'm selling covered calls and I'm usually collecting about 1 or 2% in premium. So I have that on American Airlines. I have Kraft Heinz. I'm just trying to look for an example where my covered call has made a lot of money and I may want to roll it down lower because the stock most likely fell a lot. So I'm trying to find that example. If we find a example, I'm going to open that up. So let's take a look at maybe Alibaba. So let's actually finish the positions that I have. So I have Alibaba 88 call. Other covered calls that I have currently in my portfolio looks like Oatly. I also have SPY. So SPY could be a really good example for us. Yeah, let's go into SPY. SPY is a perfect example because I have a lot of money in SPY. Specifically, if we take a look at my position, I have about 85% of my portfolio in SPY at the moment. This is basically the rock and the stability in my portfolio, kind of like the anchor, because I look at SPY for diversification. I have a lot of money at this point, right? $2 million. So I don't want to invest my entire $2 million in a single stock. So what I do is I make my life a lot simpler by investing in the S&P 500. And I also have single stocks as well, but S&P 500 is really my anchor and it provides me income because I am doing the covered call strategy, hence the title of this video, on SPY as well. So as you can see, a big position on SPY, 84.5%, 3,000 shares. I have $1.2 million. And what I want to point out is that the current stock price is $412. And the position that I have right now is the $419 covered call. Now, if you'll notice that if SPY goes down, my covered call is benefiting. So if I expand this covered call right now, I want to show you something really interesting about managing and also rolling and adjusting a position to make more money with it using the covered call strategy. So the 419 covered call is what I have right now, and you'll notice that I'm up $3,420. Now, this is interesting because SPY is falling down, and obviously my covered call position is benefiting. It's creating income. It's decaying, which is fantastic because when you're an option seller, you want the stock to basically stand still, potentially fall down a bit if you're doing the covered call strategy, but ideally it stands about still. So that's exactly what SPY is doing, and that's exactly why I've been making so much money on SPY. It's very stable. As you can see, I just did this last week and I made about $630, and then again I'm up about $3,420, which is, a pretty good stable return. If I'm able to do this on a weekly basis, then I'm making about $12,000 a month just on SPY, and that's a very safe, passive, consistent income for me. So I want to show you how to roll this though, because check it out, I've already made about 13%. Now this is not as high of a percentage as I want to see to roll this position, but for example purposes, I've already made $3,420. So if I want to make more money, and I don't think that SPY is going to go up a lot, I think it's going to continue to be stable, what I will actually do is I will roll down. Now I've shown you guys before, and I've shown my Discord how to roll up, which is protecting your gains. Okay, this is actually making more money, which is slightly different. So what I will do here is I have SPY 419 covered call. I'm going to go to roll this position, okay? And because SPY is pretty stable and it's falling down a little bit, what I'm going to do is I'm going to roll down. So right now I have the June 16 expiration. So let's just say I still want to use June 16. You don't always have to roll out, although you could. So I can use June 16, or I can just do June 30. Let's just use June 30 because it's a very slight change. It's only a few extra days, actually 2 weeks, about 14 days out further. But now what I will do is I will go from 419 down to, let's just say 418, okay? This is not even a big deal. This is a very small difference. But if I just move down by 1, yes, I'm increasing my risk very slightly, but I'm also collecting a total credit of $5,100. So rolling can make a very significant difference in your profits. And there's a lot of benefits to rolling as well, because if the stock is moving up and you can't make any more money, you can roll up and out. That's going to give you the benefit of having more capital appreciation and collecting more income. And the biggest mistake is to sometimes just hold the position and let it expire, because if it's already in the money and it continues to go up, then you are leaving money on the table. So if that happens, what you want to do next is you want to roll up. What I want to do in this scenario is I'm actually going to roll down, because the benefit of rolling down is I get an extra $5,100. Yes, I'm increasing by 14 days, but because SPY is trending a little bit lower, I can make a little bit more money. Now, this is still safe risk management because I'm only going down by about $1. And risk management is super important. So what you would not want to do is you would not want to go from 419 down to 412, which would be the current stock price. Because if SPY just goes up like 1%, you're going to miss out a lot of gains. So I would not change your strike prices too drastically. What I usually do is I adjust my strike prices very slightly to make more money, to protect my gains, or to reduce my risk. And that's really important, because reducing your risk and reducing the volatility in your portfolio not only will make you feel better, but it's also going to look a lot better in your results, because when you have less volatility and more stability, then you just basically see a portfolio that's consistently going up. Like if I go to my year-to-date return, you will notice that it doesn't have a lot of volatility, so it's very easy for me, and it's also simple for me just to rely on this income. And just to prove that I do rely on this income, if I go into my portfolio, I just want to show you that I am consistently taking money out and withdrawing from my portfolio. So if I go to transfers right now, I'll show you that I'm consistently taking money out of my portfolio because I do use this portfolio to pay my team. My team costs me over $50,000 a month, so I am taking a lot of money out of my portfolio, and I use this for lifestyle, and I also pay my team, which helps me with my Discord. If you like this video, I will be eternally grateful, and if you subscribe, I will also be really happy to have you part of the family, and I will see you in the next video.